You know what absolutely drives me insane? I watch regular people, smart people, hardworking people throw away their shot at real wealth because they break one simple rule. One rule. And I'm not talking about some complicated financial theory or some secret strategy that only billionaires know about. I'm talking about something so basic, so fundamental, that when I tell you what it is, you're going to think I'm crazy. But here's the thing. This one rule took me from working night shifts at a gas station making $8 an hour to building multiple billion-dollar companies. Not million-dollar companies. Billion-dollar companies. And the crazy part? Most people know this rule exists. They've heard it 1,000 times, but they ignore it. They think they're smarter. They think they can take shortcuts. They think the rules don't apply to them. Let me tell you about Marcus. Marcus was one of the smartest guys I ever met. MIT graduate, worked at Goldman Sachs, made more money in 1 year than most people see in a decade. This guy could analyze complex derivatives, understand market dynamics that would make your head spin, and predict economic trends with scary accuracy. But Marcus broke the one rule. And you know what happened? He lost everything. Not just his money. Everything. His house, his marriage, his reputation, his entire life fell apart because he thought he was too smart to follow one simple rule. Now contrast that with Maria. Maria was a single mom working 2 jobs just to keep the lights on. She had a high school education and knew absolutely nothing about finance or business or investing. But Maria followed the rule. She stuck to it religiously, even when people told her she was being too conservative, even when she watched other people seemingly getting rich quick all around her. Today, Maria owns a portfolio worth over $50 million. $50 million from following one rule. The difference between Marcus and Maria wasn't intelligence. It wasn't education. It wasn't connections or luck or timing. The difference was that Maria understood something that Marcus didn't. She understood that there are fundamental principles in wealth building that you cannot violate. Ever. No matter how smart you think you are, no matter how good the opportunity looks, no matter how much pressure you feel to act fast. I learned this rule the hard way. Back when I was 23, I thought I knew everything. I had read every business book, studied every successful entrepreneur, analyzed every market trend. I was convinced I had figured out the secret formula to getting rich. So I took every penny I had, which wasn't much, and I bet it all on what I thought was a sure thing. A real estate deal that couldn't possibly go wrong. The numbers made perfect sense. The location was prime. The timing seemed perfect. I broke the rule. And I got crushed. Not just financially crushed, emotionally destroyed. I had to move back in with my parents. I had to take that job at the gas station working nights because I was too embarrassed to face people during the day. I had to watch my girlfriend leave because she couldn't handle dating someone who had lost everything chasing a dream. But something interesting happened during those long nights at that gas station. I started thinking differently. I started asking different questions. Instead of trying to figure out how to get rich quick, I started studying why most people stay poor. Instead of looking for the next big opportunity, I started looking at what successful people actually do consistently over time. Instead of trying to be clever, I started trying to be disciplined. That's when I discovered the rule, the one rule that changed everything for me. The rule that every single wealthy person I've ever met follows, whether they realize it or not. The rule that separates the people who build lasting wealth from the people who chase it their entire lives and never catch it. Now, before I tell you what this rule is, I need you to understand something. This rule is going to sound boring. It's going to sound obvious. You're going to be tempted to dismiss it because it's not sexy or exciting or revolutionary, but that's exactly why it works. The most powerful principles in life are usually the simplest ones. They're the ones hiding in plain sight while everyone else is looking for complicated solutions. Think about every financial disaster you've ever witnessed. Think about every person you know who should be wealthy but isn't. Think about every company that went bankrupt despite having great products or smart leadership. Think about every economy that collapsed despite having brilliant economists and sophisticated systems. In every single case, I guarantee you'll find the same thing. Someone broke the rule. The dot-com crash of 2000, companies with no profits trading at insane valuations. The rule was broken. The housing crisis of 2008, people buying homes they couldn't afford with money they didn't have. The rule was broken. The crypto crash of 2022, people putting their life savings into digital assets they didn't understand. The rule was broken. But here's what's fascinating. While everyone else was getting wiped out during these crashes, there were people who not only survived but thrived. They saw these disasters coming from miles away. They positioned themselves to benefit from the chaos. They turned other people's mistakes into their own opportunities. How? They followed the rule. I remember during the 2008 financial crisis, while everyone else was panicking, I was buying real estate, stocks, businesses, everything was on sale. People thought I was crazy. They thought I was going to lose everything. But I knew something they didn't. I knew the rule would protect me. And it did. That crisis made me more money than any other period in my life because while everyone else was breaking the rule out of fear, I was following it with discipline. This rule isn't just about money, by the way. It applies to every area of life where you want to build something lasting. Relationships, health, career, business, investing, everything. The people who understand this rule and follow it consistently create extraordinary lives. The people who ignore it struggle forever, no matter how talented or hardworking they are. I've taught this rule to thousands of people over the years. Some of them listen, some of them don't. The ones who listen and apply it consistently always succeed. Always. It doesn't matter what their background is. It doesn't matter what their education level is. It doesn't matter what industry they're in or what economic conditions they face. If they follow the rule, they win. The ones who don't follow it make excuses. They tell me the rule is too simple. They tell me it won't work in their situation. They tell me they need to move faster or take bigger risks or find some special opportunity that nobody else knows about, and then they wonder why they keep struggling while other people pass them by. Here's what I want you to understand. Wealth building isn't about being smart. It's about being disciplined. It's not about finding the perfect opportunity. It's about consistently doing the right things over time. It's not about timing the market. It's about time in the market. It's not about taking big risks. It's about managing risk intelligently. The rule I'm about to share with you embodies all of these principles. It's the foundation that everything else is built on. Without this rule, nothing else matters. You can have the best investment strategy in the world, but if you break this rule, you'll lose. You can have access to the most exclusive deals, but if you break this rule, you'll fail. You can have all the knowledge and connections and resources in the world, but if you break this rule, you'll end up broke. This rule, you'll end up broke. The wealthy people I know, the ones who've built generational wealth, they all have one thing in common. They're boring. I'm serious. You meet them expecting some flashy entrepreneur with crazy stories and wild risk-taking adventures. Instead, you get someone who sounds like your accountant. They talk about compound interest and diversification and dollar cost averaging like it's the most exciting thing in the world. But here's what I realized. That boring approach is exactly why they're wealthy. While everyone else is chasing the next hot stock tip or cryptocurrency or get-rich-quick scheme, these people are doing the same simple things over and over again, month after month, year after year, decade after decade. I used to think that was weakness. I used to think successful people took massive risks and made bold moves that separated them from the crowd. I was completely wrong. The biggest risk you can take is not following the rule. The boldest move you can make is having the discipline to stick with it when everyone around you is doing something different. Let me paint you a picture of what breaking this rule looks like in real life. You've got some money saved up. Not a lot, but enough that you're starting to think about growing it. You hear about this amazing opportunity. Your brother-in-law's friend is starting a restaurant. The location is perfect. The concept is unique. They just need investors and they're promising huge returns. You've eaten there. The food is incredible. The place is always packed. So you take your savings, maybe it's $10,000, maybe it's $50,000, and you invest it all. You're excited. You're finally taking action instead of just letting your money sit in a boring savings account earning nothing. You tell yourself you're being smart. You're being entrepreneurial. You're thinking like a wealthy person. 6 months later, the restaurant closes. Turns out running a restaurant is harder than making good food. Turns out location and concept and packed dining rooms don't automatically translate to profits. Turns out your brother-in-law's friend had no idea what he was doing from a business perspective. Your investment is gone. All of it. Now, was that a bad investment because restaurants are risky? No. Was it bad because your brother-in-law's friend was incompetent? Not necessarily. It was bad because you broke the rule. You put all your eggs in one basket. You invested money you couldn't afford to lose in something you didn't understand. You made an emotional decision based on limited information. Compare that to someone who follows the rule. They have the same $10,000. They hear about the same restaurant opportunity. They might even invest in it. But they invest $500. one small piece of a diversified portfolio. If the restaurant succeeds, great, they make some money. If it fails, which it does, they lose $500 instead of $10,000. The failure doesn't devastate them. It doesn't set them back years. It doesn't force them to start over from zero. This is the difference between people who build wealth and people who chase it. People who build wealth understand that any individual investment can fail. Any single decision can be wrong. Any particular strategy can backfire. So they never bet everything on any one thing, ever. But it goes deeper than just diversification. The rule isn't just about spreading your money around, it's about understanding the fundamental nature of risk and return. It's about recognizing that sustainable wealth is built through consistent, disciplined actions over long periods of time. It's about having the patience to let compound growth do its work instead of trying to force dramatic results immediately. I watch people violate this principle in 100 different ways. They day trade trying to time the market perfectly. They chase whatever sector is hot this year. They constantly buy and sell based on news headlines or market volatility. They think they can outsmart the system through cleverness or effort or superior analysis. Meanwhile, the wealthy people I know do the opposite. They buy quality investments and hold them for decades. They ignore short-term market movements. They focus on businesses with sustainable competitive advantages and predictable cash flows. They understand that wealth building is boring by design because boring equals consistent and consistent equals compound growth. Here's something that will blow your mind. Warren Buffett, one of the richest people in history, has generated most of his wealth through boring investments in boring companies. Coca-Cola, American Express, Apple. These aren't revolutionary startups or cutting-edge technologies. They're established businesses with moats around them that generate predictable profits year after year. But people don't want to hear that. They want to hear about the next Amazon or the next Google. They want to find the stock that's going to go up 10 times in 2 years. They want to believe there's some secret formula or insider knowledge that will shortcut the process of wealth building. The rule I'm about to share with you destroys that fantasy. It forces you to accept that building real wealth requires time and discipline and patience. It requires you to do things that don't feel exciting in the moment. It requires you to delay gratification and think in decades instead of months. This is why most people never follow the rule even after they learn it. It's not complicated enough for them. It doesn't feed their ego. It doesn't make them feel special or clever. It makes them feel ordinary. And nobody wants to feel ordinary. But here's the secret. Successful people understand. Extraordinary results come from doing ordinary things extraordinarily well over extraordinary periods of time. The rule embodies this principle completely. It's simple to understand but difficult to execute because it requires you to act differently than your emotions want you to act. When markets are crashing and everyone is panicking, the rule tells you to stay calm or even buy more. When markets are booming and everyone is euphoric, the rule tells you to stay disciplined and not get caught up in the excitement. When you hear about amazing opportunities that seem too good to be true, the rule protects you from making catastrophic mistakes. The rule has saved me from countless disasters over the years. Deals that looked incredible but would have wiped me out. Trends that seemed unstoppable but crashed spectacularly. Investments that promised massive returns but delivered massive losses instead. Every time I was tempted to break the rule, every time I thought my situation was different or special, the rule kept me grounded. And every time I followed the rule, even when it felt conservative or boring or slow, it worked. Not immediately, not dramatically, but consistently, reliably, powerfully. The compound effect of following this rule for decades has created more wealth than any individual brilliant investment ever could have. That's the power of compound growth when it's protected by discipline. When you follow the rule, you don't just make money, you make money on your money. You make money on the money you made on your money. You create a snowball effect that starts slow but becomes unstoppable over time. I remember when I first started following the rule religiously. It was frustrating. I'd watch other people making what seemed like incredible returns on crazy investments while I was methodically building my wealth through what felt like baby steps. A friend of mine made $30,000 in 1 month trading penny stocks. Another guy I knew bought some random cryptocurrency and tripled his money in 2 weeks. Meanwhile, I was making my boring investments, following my boring strategy, getting my boring but consistent returns. These guys would tease me about being too conservative. They'd say I was missing out on the real opportunities. They'd show me their portfolio gains like trophies. But here's what happened next. The penny stock trader lost everything within 6 months. Not just his gains, his entire principal. The crypto guy held on too long, thinking his coins would keep going up forever. When they crashed, he lost more than he had originally invested. Both of them ended up worse off than when they started. Meanwhile, my boring approach kept working. Month after month, year after year. The compound growth was slow at first, but it was consistent, and consistency over time creates miracles. After 5 years of following the rule, I had more wealth than both of those guys combined. After 10 years, it wasn't even close. This is what people don't understand about wealth building. It's not about hitting home runs. It's about getting on base consistently. Singles and doubles win championships. Home run hitters who strike out most of the time end up with terrible batting averages. The rule forces you to think like a successful baseball player instead of thinking like a gambler. Gamblers swing for the fences every time. They go all in on every hand. They bet everything on the outcome they want instead of the outcome that's most likely. And gamblers always lose in the long run because the house always wins. But people who follow the rule think differently. They understand that wealth building is a process, not an event. They understand that sustainable success comes from managing downside risk, not from maximizing upside potential. They understand that the goal isn't to get rich quick, the goal is to get rich and stay rich. Let me tell you what this looks like practically. When you follow the rule, you never invest money you can't afford to lose, ever. I don't care how good the opportunity looks. I don't care how much research you've done. I don't care if your best friend's brother works at the company and has insider information. You never risk money that you need for basic living expenses or emergency situations. When you follow the rule, you diversify across different types of investments. You don't put everything in stocks. You don't put everything in real estate. You don't put everything in your own business. You spread your risk across multiple asset classes so that if one area gets hammered, your entire financial life doesn't collapse. When you follow the rule, you invest regularly, regardless of market conditions. When stocks are expensive, you buy less. When stocks are cheap, you buy more. But you keep buying consistently because you understand that timing the market perfectly is impossible and trying to do it will destroy your returns. When you follow the rule, you ignore the noise. You don't make investment decisions based on news headlines or market predictions or what some expert said on television. You stick to your strategy through bull markets and bear markets and everything in between because you know that emotional decisions are wealth killers. When you follow the rule, you think in decades instead of quarters. You're not trying to maximize this year's returns. You're trying to maximize your wealth over the next 20 or 30 years. This completely changes how you evaluate opportunities and how you respond to short-term volatility. I've seen people who understand this concept intellectually but can't execute it emotionally. They know they should diversify, but they put 60% of their money in their company's stock because they believe in it. They know they should invest regularly, but they try to time the market anyway because they think they can spot trends. They know they should ignore the noise, but they panic and sell during market downturns because they can't handle watching their portfolio values decline. The rule doesn't just tell you what to do, it tells you what not to do. And often, what you don't do is more important than what you do. Not panicking during crashes, not chasing hot investments, not changing your strategy based on temporary results, not investing money you need for other purposes. These negative actions, these things you avoid doing, are just as crucial as the positive actions you take. Here's something that took me years to fully grasp. The rule isn't just about protecting your money, it's about protecting your psychology. When you break the rule and lose money, you don't just lose the money, you lose confidence. You lose trust in yourself. You lose the emotional stability needed to make good long-term decisions. I've watched brilliant people make one catastrophic mistake that didn't just cost them money, it cost them their nerve. They became so afraid of losing again that they couldn't take appropriate risks. They went from being too aggressive to being too conservative. They never found the balance that the rule provides. The rule creates psychological safety. When you know that no single investment can destroy you, when you know that you're diversified and disciplined and thinking long-term, you can weather any storm. Market crashes don't terrify you because you expected them. Investment failures don't devastate you because you planned for them. Economic uncertainty doesn't paralyze you because you prepared for it. This psychological stability is worth more than any individual investment return. When you have it, you can think clearly during chaotic times. You can spot opportunities when everyone else is panicking. You can make rational decisions when everyone else is making emotional ones. You become the person buying when others are selling and holding when others are running. But it takes practice. Following the rule isn't natural. Our brains are wired for immediate gratification and dramatic action. We want to see big results right now. We want to feel like we're making progress every day. We want to beat the market and prove how smart we are. The rule asks you to do the opposite. It asks you to be patient when you want to be aggressive. It asks you to be conservative when you want to take big swings. It asks you to be boring when you want to be exciting. This goes against every instinct most people have about money and success. That's why so few people follow it consistently. They start with good intentions, they understand the logic, they create a plan based on the rule. But then life happens. Markets get volatile. They hear about amazing opportunities, they see other people making money in ways that seem easier and faster, and they abandon the rule for something that feels more immediate and exciting. I cannot overstate how costly this pattern is. Every time you break the rule, you're not just risking that particular investment, you're risking the compound growth that comes from staying disciplined over long periods. You're interrupting a process that gets more powerful the longer it runs uninterrupted. Think about compound interest for a second. If you invest $1,000 and it grows at 10% per year, after 10 years you have about $2,600. After 20 years, you have about $6,700. After 30 years, you have over $17,000. Same investment, same return rate, but the later years produce dramatically more growth than the early years. Now imagine you break the rule halfway through and lose half your money. You don't just lose that money, you lose all the compound growth that money would have generated over the remaining years. A $15,000 mistake in year 15 costs you much more than $15,000 in total wealth. This is why wealthy people are so fanatical about protecting their capital. It's not just about the money they might lose, it's about the future growth they're sacrificing. Every dollar you lose today is really $10 or $20 or $50 you won't have in retirement. The rule protects you from these catastrophic interruptions to compound growth. It keeps you in the game consistently so that time and mathematics can work their magic. It prevents you from making the emotional decisions that destroy long-term wealth building. But here's what's really beautiful about the rule. Once you truly embrace it, once you internalize it completely, investing becomes almost effortless. You don't agonize over individual decisions because you know you're diversified. You don't panic during market downturns because you expected them. You don't chase performance because you're focused on process. You develop what I call wealthy person thinking. Instead of asking, how can I get rich quick? You ask, how can I build sustainable wealth? Instead of looking for the next hot investment, you focus on boring consistency. Instead of trying to time the market, you let time in the market do the work. This shift in thinking changes everything. Not just about money, but about life. You become more patient, more disciplined, more focused on long-term outcomes instead of short-term gratification. These qualities serve you well beyond investing. They help you build better relationships, advance your career, maintain your health, and achieve any long-term goal. The rule isn't just a financial strategy. It's a life philosophy. It teaches you that sustainable success in any area requires discipline, patience, and consistency. It teaches you that extraordinary results come from doing ordinary things extraordinarily well over extraordinary periods of time. Ordinary things extraordinarily well over extraordinary periods of time. So what is this rule that's transformed my life and the lives of thousands of others? What's this principle that separates the wealthy from everyone else? The rule is this: never put all your eggs in one basket, ever. I know what you're thinking. That's it? That's the big secret? Diversification? You've heard that a million times. Your financial advisor told you that. Your dad probably told you that. It's the most basic concept in investing. But here's what you don't understand. There's a massive difference between knowing about diversification and actually practicing it correctly. Most people think they're diversified when they're not. They think they understand the rule when they're completely missing the point. True diversification isn't just about owning different stocks. It's not about buying 5 tech companies instead of 1. It's not about splitting your money between Apple and Microsoft and calling it balanced. Real diversification is about understanding that correlation kills you when you need protection most. Let me explain what I mean. In 2008, people thought they were diversified because they owned different financial stocks. They had Bank of America and Citigroup and Goldman Sachs. But when the financial crisis hit, all those stocks crashed together. Their diversification was an illusion because all their investments were exposed to the same underlying risk. The same thing happened with tech stocks in 2000. People owned Amazon and Pets.com and hundreds of other internet companies. They thought they were spread out. But when the bubble burst, everything collapsed simultaneously because it was all the same bet on the same theme. True diversification means owning assets that behave differently under different conditions. When stocks are falling, bonds might be rising. When real estate is struggling, commodities might be thriving. When domestic markets are down, international markets might be up. You want investments that don't move in lockstep with each other. But it goes beyond just asset classes. You need to diversify across time, too. This is where most people completely miss the boat. They try to time their investments perfectly. They wait for the perfect moment to buy. They try to predict when markets will be at their lowest or highest. The rule says you invest consistently over time, regardless of what markets are doing. You buy when prices are high. You buy when prices are low. You buy when everyone is euphoric. You buy when everyone is terrified. You smooth out the timing risk by spreading your purchases across months and years and decades. This is called dollar cost averaging, and it's one of the most powerful wealth-building tools ever created. But people hate it because it feels passive. It feels like you're not being smart or strategic. You're just mechanically putting money to work without trying to optimize the timing. That's exactly why it works so well. It removes emotion from the equation. It prevents you from making the timing mistakes that destroy most investors. It ensures that you buy more shares when prices are low and fewer shares when prices are high. Over time, this creates a lower average cost per share than any timing strategy ever could. I've been dollar cost averaging into the same core investments for over 20 years now, through the dot-com crash, through 9/11, through the financial crisis, through COVID, through every market panic and euphoric bubble in between. The consistency has been magical. But here's where people really struggle with the rule. They think diversification means you can't concentrate on your best ideas. They think it means you have to settle for average returns by spreading your money too thin. They think it conflicts with the advice to invest in what you know best. That's completely wrong. The rule doesn't prevent you from having conviction. It prevents you from betting your entire future on that conviction being right. You can absolutely put more money into your highest confidence investments, but you never put so much that being wrong will devastate you. Think of it this way. If you have 10 investment opportunities and you rank them by confidence level, you might put 20% in your top choice, 15% in your second choice, 12% in your third choice, and so on. You're still concentrating on your best ideas, but you're not risking everything on any single bet. This approach protects you from the overconfidence bias that destroys so many smart people. The smarter you are, the more likely you are to believe your analysis is correct. The more successful you've been, the more likely you are to think you can't be wrong. The rule forces you to acknowledge that even your best ideas can fail. That's the rule. Never put all your eggs in one basket. Ever. And I know it sounds simple, but most people will hear this and do absolutely nothing with it. They'll think they already knew it. They'll convince themselves they're already following it. They'll find reasons why their situation is different or special. That's exactly why most people stay broke, while a few build generational wealth. The rule isn't complicated, but it requires discipline that most people simply don't have. Follow it religiously, and you'll join the wealthy. Ignore it, and you'll keep wondering why success always seems to slip through your fingers.